Hi everybody, it's Thursday, October 2nd, 2025. Our episode starts with our first headline, crude oil breakdown. Since the beginning of August, we have seen crude oil bouncing back and forth between $65 a barrel and $61 a barrel. Today, as of the recording of this episode, we have finally cracked decisively and strongly through this bottom line here, with crude oil currently sitting at $60.74. Of course, the headlines are blaming it on oversupply, but it's not an oversupply if there's enough demand. Lower prices typically increase demand because it's easier to get it and people will be more willing to buy it. And so from my perspective, the suggestion that it's just a oversupply concern is only half the story. And while we're talking about crude oil, we might as well bring up the U.S. 10-year Treasury note yield, which typically follows crude oil. With crude oil finding, new lows over the past few months, it's interesting the 10-year, it hasn't followed it yet, but it typically does. Usually when oil goes down, the 10-year note follows. And so as I've been suggesting on the show and predicting with my crystal ball and all that we will be dropping below 4% in the 10-year Treasury note yield. I am still expecting that, and I'm expecting that to a stronger degree at this point. So TLT is my favorite place to be. Second headline, Robschild buys UPS and CAG stock. And those two purchases have been updated on my website in the description of my video. You can see at the bottom, change log, and you can click on them to understand a very brief explanation. Actually, it looks like I didn't finish this one yet. I'll update that right after this. After freeing up a good amount of cash from selling UNH, KWeb, and REMX, I went shopping today and lowered my cash position from 22% down to 18% now. So now I will walk through why I bought these two stocks, starting with CAG and then UPS. CAG is Conagra Brands. This is a consumer defensive brand that sells food products. Obligatory reminder, nothing you hear on this video or see in my website should be taken as any kind of financial advice. Do your own homework, make your own choices. If you want to do it the way that I do it, you can go straight to my website, the Stock Research Center right here. Type in your ticker symbol, in this case CAG for Conagra, and we have the first link up here, Macro Trends EPS. It's my favorite way of quickly getting a decent history of earnings per share. And we can see that this company over the past 15 years, since 2010, has had a pretty good earnings record. It looks like we had some trouble in 2015 and 16. Also quarterly, it looks like quarter 2, I guess that would be quarter 1 of 2024, we also had negative earnings. Besides that, it's nothing too scary. Then one thing I like to do is scroll up and just take a quick look at the revenue to make sure revenue is not completely falling off of a cliff. And although revenue did drop quite a bit in 2015, we've been fairly solid since then. A drop in revenue like this often suggests that there was a spin-off, especially for being a food company, or some temporary distortion. It looks like we had that one quarter where revenue dropped a lot. Anyhow, not any major alarm bells for me. Next, I'm going to take a look at the Yahoo Finance balance sheet just to make sure things are okay here. And we can see current liabilities actually outweigh current assets a little bit here. And we've seen that, but it's been consistently like that for a little while. And my take on that is, unless people stop buying food, money should keep coming in. This is not a cyclical company. This is a defensive company. If anything, people will be buying more groceries and going out to eat less if there is a downturn in the economy, for example. And then opening up the total non-current assets, I see they have a lot of goodwill priced in here, $10.5 billion. I don't love seeing that, but I do like seeing that it's been reduced since 2022. When we take that out of the total assets, we're left with, let's say, 20 billion, 10 billion about there. And that's actually less than their total liabilities, which for some companies can be an alarm bell. But for, again, a company that's not really expected to have any sort of major slowdown in business, higher liabilities add leverage to the stock. The way it works is when you have more of the capital, more of the working capital in debt, then it means that a larger portion of the earnings goes to service the interest on that debt. And so the earnings themselves then have more beta, which can make the stock price actually have more beta. So when things are looking better, the stock goes up further and vice versa. Sometimes that can be an alarm bell for companies, but again, being a consumer defensive company and having such a long dividend record, which we're going to take a look at next, I'm more excited about the undervaluation than any worries that I have. Since 1985, Conagra has been paying a growing dividend, notably through the dot-com era. We had a dividend record that did not even dip. It just went up through that period and just kept going up. We keep going up. And then looking through the great financial crisis, same thing. We have no interruptions of the dividend yield. And by October 2009, we actually had an increase of the dividend, continuing all the way up until today, where we currently have a 35% dividend per quarter. And this is the equivalent of, at its current stock price of $19.30, this is the equivalent dividend yield of 7.65%. The current price also represents a 10-year average earnings PE ratio of only 13. Leading companies in industries can and often have a fair price valuation of it being 25, but it had some negative earnings. So how do you calculate how high can you think that it should go from here? And what I do is I take a look at what a fair dividend yield for me for a company like this would be. And for me, a normal dividend payment for a company like this, for me, should be between 4 and 5%, which would represent a price currently between $29.41 and $36.66. And that is my exit plan. I also want to note that, going into the dot-com bubble, when the dot-com bubble represented by this pink line here, this is SPY, this is the S&P 500, this pink line, when it was at its peak before the dot-com crash, Conagra was, at its absolute bottom in March of 2000 at only $11.81. And while the dot-com bubble was bursting, Conagra went up in price, which is ordinary to see in a risk-off environment. And investors are getting defensive. They are become more attracted to companies like Conagra. Lastly, I also want to mention that its current price of CAG has not been seen since 2012. So I bought it. Next, UPS. You probably know who they are. They ship things for people. It's got wide moat, low competition space with very large initial capex requirements for any potential rising competition. There's a lot of regulation that actually protects UPS. They have an extremely solid dividend record as well, including through the dot-com bust and the great financial crisis. Recent declines in revenue and earnings are likely transitory, currently also yielding a similar amount, 7.77%. And my exit plan is to sell between $133.50 and $166.50, representing a 4 to 5% dividend yield. So again, starting with macro trends, looking at the earnings per share, you can see that we've had a bit of a decline, but it's been a bumpy road for a while. The earnings are a bit volatile. They go up and they go down. Also, the revenue, 12 trailing month here, has been going down a little bit since 2022, but not anything crazily concerning in my book. Quick acid test current assets to current liabilities. It's fine. It's not going to go bankrupt. And like I said earlier, with a dividend record, extremely solid dividend record through the .com bust. Never budging, never pausing, never going down. Same through the great financial crisis, just going up and up and up all the way until today. So its current price, having a 10-year average earnings PE ratio of only 12.4 and a dividend of 7.7%, and a previous stock price at its peak in 2022 at $231 a share, currently $85 a share. The last time this company was at this price was the 2020 COVID crash in stocks. And then before that, we haven't seen this price really since, you could argue, 2013. Also, the pink line being SPY, going collapsing during the .com bust. We found a bottom in UPS in September of 2001, where we were actually we went up by 44% during the final descent of the S&P 500 in the .com bust. So if this AI bust is anything like the .com bust, both of these companies proved to be pretty decent places to be. So those were my moves today. Did you make any moves today? Comment below. Robschild buys CAG and UPS. Also, thank you for all of your crystal ball ratings on how high SPX will go. I know some people are looking at 7,000 and everywhere between. Coming up, the economic data is in limbo. We did not have initial continued jobless claims come out today because the federal government is shut down. Again, I believe that this is a tailwind for the stock market. After all, if mainstream, the mainstream news and your retail investor doesn't have any news to sell off in the markets, well, why not keep letting it go higher? When this data does drop, that might actually be the pinprick that pops the AI bubble. Maybe. Just a crystal ball rating. So yeah, Friday, no unemployment report for now. And we may not see it for weeks at this point. So, but we may still see some tariff updates. Before we get on to the rest of our charts, thank you for watching, liking, subscribing, commenting, and supporting Robschild. And no changes to the crystal ball ratings. And click on my website in the description to read through my daily reminders, current macro views, portfolio explained, and stock research center, which will be getting updates in the very near future. On to the charts, starting with SPX, the S&P 500, opening higher today and having a bit of a red candle, but we did get an all-time closing high. SMH, the semiconductor index, also rose by 1.36% today. Copper also got a bid going higher. I'm going to say we're going to have to cancel the idea that this is a bear flag anymore. This is simply bullish at this point. We have higher highs and higher lows. Next up, Bitcoin. I went a little bit trendline crazy recently. We did break, and it looks like we are probably going to confirm above my orange line that I explained in yesterday's show, dating back to 2017. Connecting to the ultimate high of 2021. That's this line right here. Looks like we're going to close above it, and so it does look like Bitcoin will be reaching up to about 127,000. I opened a very, very small short at this line, and I will quadruple it at this level around 127. There was also risk on activity in total too. All cryptos minus Bitcoin rising today quite a bit, 2.8%. Gold finally giving a little bit of a breather here. With this amount of momentum, I have no idea where the top's going to be. We could drive straight up to 5,000 at this point. I have no idea. My crystal ball has nothing other than being amazed at how much gold costs compared to everything else on the planet. It's very expensive. Next, small caps. I just wanted to bring up IWM ETF. Did rise today, but still not getting to higher highs. However, the advanced decline line in the S&P 500 did tick up today, suggesting that more stocks were participating in today's move up than not. And the last chart for today I wanted to bring up was the high yield index option adjusted spread on Fred. This is junk bond spread. How much do junk bonds have to yield above the treasury rates? And I just wanted to note, when you scroll into the very end here since September 22nd, we are actually seeing higher highs, higher lows. So we need to be careful here with assuming that stocks can keep going higher. Since Liberation Day, credit spreads, junk bond credit spreads have been getting tighter and tighter and tighter. And just very recently, this very tail end, we've been ticking up. So if that continues, it certainly takes the legs out of the stock market, and we will be expecting more volatility. Overall, though, the big picture here as far as day-to-day movement goes in markets, without major economic data coming out, no jobs data, no employment report, I am actually at this point expecting markets to float higher until we get that data. But that's just me and my crystal ball. And that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching and see you next time. Robschild.